A couple of things to talk about today. First, should you convert your IRA or simple IRA to a Roth? There are some rules, some things you should know about. We don't want to get tripped up. So there's a right way and a wrong way to go about it. The other thing I want to talk about is, and this is the topic that everybody wants to know, are we going to have tariff induced inflation or a tariff induced recession? And until investors decide which one, I think the stock market's starting to look a little bit range bound. More of a downward bias still, but range bound. I don't think we get a swish down or a swish up. I think investors just want to hold on to see what the actual tariff policies are going to be because they're still in flux, and we want to see how that's going to affect the economy. All right, so we're going to roll a quick intro, and these are the things we're going to talk about. This is going to be a very interesting and intellectually stimulating conversation. I hope you'll ask your questions in the comments, whether if you're watching in the live stream or the replay. If you don't mind, give us a thumbs up or a heart. Helps other people see the good work we're doing, and I get to see who's out there. Okay, here's the intro. We'll be back in, I think, about 15 seconds. Right, welcome back. I'm Mitch Goldberg with the wealth management firm Client First Strategy. Check us out at clientfirststrategy.com. I was talking to Bobby Bird, my partner and dear friend, and we come to our own conclusions, but we convene many times during the week to talk about that. And it's amazing how we are often on the same page. You know, before the market peaked on the way up, we were very keen, and my clients who will watch this will know, I've got the receipts, and I talked about it here many times, taking gains out of some of the massive winners. How many videos did I post? Did you see me post about NVIDIA? Should you take gains? Comparing it to stocks of the year 2000 when we had the tech wreck. I know this 25 years ago, but when you live through a painful period, it's never a long time ago. It's always, right there behind you, never leaving you alone. I guess that's trauma, right? But we talk about this stuff and we debate. I wouldn't say debate, we discuss, we generally agree, so it's not a debate, that the thing with the market now is tariffs are inflationary because you pay higher prices. You and me, we pay higher prices. They're not borne by a foreign company or a foreign country. Price increases are passed along to us. So that's inflationary. And the Federal Reserve, which is wrapping up a 2-day meeting tomorrow, and it's 99% chance, according to current market stats, that they're not going to lower rates, they're not going to raise rates. The Fed is just going to hold pat at about 4.5% on the Fed funds rate. So, but the Fed also wants to see how this affects the economy. So what happened? Which one wins? We pay higher prices because of tariffs, which is inflationary, or is it recessionary because higher prices will squash demand, will tamp down demand? So if demand goes down, what do we see? Well, we see lower profits because tariffs. When companies like a Walmart or a Target has to charge you more money because of tariffs, they're not getting that money. It's not like, if Walmart raises their prices on goods because of a tariff, it's not like Walmart's going to get more earnings. It's not falling to their bottom line. It just means they're compensating the actual importers who then pay the tariff, who then have to pass that along to the retailers and the wholesalers, and then they pass it along to us, the consumer. That's how it works. There's wholesalers, there's retailers, there's importers, there's there's a whole chain. It's not like Walmart. It's like somebody in your store in your local Walmart is running to the port in Long Beach or LA, California, and they're just gonna, pick up the goods and drive them to the store. I mean, these things go through lots and lots of channels, distribution channels. So if demand is tamped down, that'll compensate for the price increases, but not in a good way. It'll be because consumers pull back. They decide they have to, consumers will have to be more choosy about how they spend their dollars. And companies and retailers sell less of everything because, that's the way it works. Prices go up, demand goes down, and investors try to switch to something else. Now, investors could switch to domestically produced goods, which is now, let me say that again. Now, investors could switch to domestically produced goods, which is what the Trump administration is trying to encourage. And I applaud that, but it doesn't happen quickly. It takes time for supply chains, manufacturing, and all the things that need to be done here. It takes years, decades. The United States we just generally don't produce TVs. We don't produce cell phones. We don't produce toys. This is low margin stuff. I'm not saying the components like the semiconductor chips that go into electronics isn't complicated, but once they're made in, let's say, Taiwan, they're shipped to China, they're assembled there, and then they're shipped all over the world, in particular the US. So it's just that we don't have a fallback plan. So I'm sure domestic producers and retailers will get away with raising their prices of goods that are not affected by tariffs because the demand for those goods will go up. And that'll be a profit center, but it'll be hurt by the tariffs. So one school of thought is rising tariffs will crush demand. Less products bought, less products produced, more unemployment. The 10-year Treasury yield is pretty low. It's the yield curve, meaning the 2-year yield on the 2-year yield on the 2-year Treasury is dived below the yield of the 10-year yield. These are recessionary indicators. Low long-term yields in Treasury bonds is a recession indicator, or at least a slowdown. So I don't think we get inflation. I think we get a recession that more than destroys demand, and it'll destroy inflation too, but not in a good way. It's not something that we'd want. If it's a recession and prices are up, but fewer people are buying goods, the Fed is in a box. So let's say a company sells 100 million widgets for $1 a piece. Now those widgets, which are produced overseas, cost $1.25. But now, people are only going to buy 75 million of those widgets. They're still $1.25. So if we go from $1 to $1.25, that's inflationary. So the Fed can't cut rates, but people will be buying a lot fewer of those, which will result in job losses, not just internationally, but here in the United States as well. So these are the things that we discuss. It remains to be seen. What if Trump backs off on tariffs? What if there's an agreement? Right? What if things work out? And that's one reason why I don't think it pays to bail out of every stock you have and go to cash when you're a long-term investor and you've got decades ahead of you to grow your assets because you want to have enough money one day to live off of your assets when you give up your income in retirement. Also, you want your assets to keep ahead of inflation. Now, I know what you're thinking. Well, if the stock market goes down, how's that keeping ahead of inflation? I have less money. It's over time. The stock market has historically produced a return above and beyond the rate of inflation over time. And there are plenty of times when the stock market has returned way above the inflation rate. And there's fewer times when the stock market is yielded less than the inflation rate. More years than not, the stock market goes up than down historically. Past performance is no guarantee of future performance, but that's the way it's been working, and that's what I'm going to continue to stick with. Okay, so we have this battle of tariffs, but what if Trump does back off? What if what if he does? Well, maybe our uh, countries that I thought that we're allies with, that I hope we stay allies with, but maybe other countries and foreign companies won't trust President Trump because he could just change his mind on a whim. Like, what? Oh, that pissed me off. Now I'm going back to the tariff. Now not am I going to charge you 25%, but I'm going to charge you 100% tariff. Like, you can have all the agreements and treaties and trade agreements you want. But if you're dealing with somebody who doesn't abide by them and only abides by them when it's convenient for him, that's not really a partner you can negotiate with. So right now, Canada and Europe are really tying up quickly. European countries are tying up with each other quickly. I hate to say it. I think the United States could be the odd man out. It's not enough to save us that we have the biggest economy in the world. It's not enough to just we don't. It doesn't give us the ability to say screw everybody else. We're just going to go it alone. It will hurt our economy. So, and we're already seeing that. We're already seeing how domestic producers who sell products overseas are getting squeezed. Bourbon makers, for one. By the way, we get a lot of energy and a lot of wheat. A lot of agriculture comes from Canada. And you think, well, but we're energy independent. We have lots of refineries that are only good at refining sour crude from Canada. That's going to be a hell of a transition to go from refining all that to refining domestically produced energy, which we export a good deal of it because foreign refineries don't have the capacity to export sour crude the way we do. This is why oil is a global commodity, not just priced here. And this is why we import energy as well as export energy, because of the way the refining industry globally is set up. That's not going to change overnight. Can the Americans go through a lot of pain? You and me, can we do that? We do have an election coming up, midterms coming up. And I think, investors have a long memory. And so I think even if tariffs go away, I think the confidence as I think investors globally have lost confidence in the United States as an honorable trade negotiator. And a lot of people could watch this and say, well, too bad, screw everybody else. Let's go along. They have more to lose than us. Doesn't mean we don't have something to lose. And I don't think it's clear cut that we will always have less to lose than competitors. President Trump campaigned on a very bad feeling about the economy amongst the population. Not everybody, but enough people to win the presidency, right? He campaigned on inflation. He campaigned on improving our standard of living. I don't think he's going about it the right way. And I think investors are going to feel that. But I could be wrong. And we may very well be in a very good position. Industrial production numbers came out today. They were better than expected. Housing starts came out better today. They were better than expected. Retail sales did fall a little bit, but not as much as expected. They weren't terrible. Now, I know this is new. We just started with the government job layoffs and all that, but a lot of people are being called back to work either through the courts or just because the wrong people were fired, like people who were in charge of protecting our nuclear weapon arsenal, that sort of thing. But we just don't know, and we'll find out more in the months ahead. This doesn't mean you shouldn't invest. This doesn't mean if you're contributing to a retirement plan every month, it doesn't mean you stop. The fact is, a down market is your friend because you're accumulating more shares while you're putting the money in. I know people have more confidence when the market's up, but it's backwards. You should be investing. It's better to invest now than, 2 months ago. So that's the sort of thing that we talk to our investors about. And now I want to do a little personal finance segment. How about that? Oh, yeah. Personal finance. Did I lose it? Am I with you? Pretty cool, right? Yeah, I love doing stuff like that. So, personal finance, we're going to talk about Roth IRAs. So, the questions I get are, well, isn't there a 10%? Isn't there a 10% tax penalty when you take an IRA distribution before age 59 and a half? The answer is yes, except for a Roth conversion. If you're converting IRA money directly into a Roth, you don't have to pay the 10, you're not penalized. You don't pay the 10% penalty. So if you're converting, $20,000 from an IRA to a Roth, there's no penalty. But if you're taking $20,000 out of an IRA to put in your pocket, 10% is $2,000. Plus you pay taxes on the full $20,000. It's not like you pay taxes on the $18,000 because you pay the $2,000 penalty. Okay, 20,000 minus 2,000 is 18,000. So let's just pay taxes on 18,000. Now you're getting taxed on the full 20,000 plus a $2,000 penalty under 59 and a half years of age. But if you're moving that money to a Roth contribution, you're taxed on the $20,000 from the IRA to the Roth, but because it's a Roth conversion, there's no 10% penalty. Now, when could you take the money out of the Roth? Well, two things have to happen. Okay, just to be sure, you could take the money out of a Roth whenever you want. But if you do, there are things that could happen. If you convert money from an IRA to a Roth IRA and you want to skip that 10% penalty, you have to have it in the IRA from the first time you make the contribution, the conversion, 5 years. You got to do a 5-year test. And you have to be over 59 and a half. So if you do it when you're 58, potentially you'd have to wait till you're 65, because up to 64, you'll get hit with that 10% penalty. So that's how that'll work. If you have more questions about this, reach out to me. I'm not a tax advisor. I'm not a legal advisor. I'm not your mama. I'm not your papa. So you should we always consult with our clients' tax advisor when we make moves like this. All right. It doesn't hurt. And I actually think it's a good way to develop a rapport with my clients' tax advisors as well. Can you move money from a simple IRA to a Roth IRA? The answer is yes. Let's say you leave your company, you move the simple IRA to an IRA. You can do that. If you're still working, you could contribute. You could move your simple IRA to a Roth IRA, but you have to have started the simple IRA at least 2 years prior. All right. So you can do it. So these are the things. What you could also do is just set up a simple Roth IRA, which is what we did here. You could do a simple Roth IRA, and that would save you the trouble. Can you do a backdoor Roth IRA? Backdoor Roth IRA means if you you don't have to worry about income limitations to put money into a Roth IRA. So you make a IRA contribution, but you don't deduct it, and then you just flip that money into the Roth IRA. And that's called the backdoor Roth IRA. So a lot of people do that, providing you are not putting money into an IRA already, because the most you can put into an IRA is $7,000, $8,000 if you're over 50. So you could do it, but if you're in a 401k, then you're fine, because a 401k is not an IRA. But if you're putting money into a simple IRA or an IRA and it's more than $7,000 or $8,000, depending on your age, no, then you are SOL. You cannot convert, or you cannot do a backdoor Roth IRA. So these are some of the rules that I like to talk to people about. I bring these up to people because they might not have thought about it, and I want to make sure that they're confident, the clients are confident that they're not missing anything. All right, so we're about 20 minutes into it, and I think what I'm going to do is end this, and I will be back tomorrow, and we'll have more things to talk about. So get your questions ready. And you can send me an email as well, mgoldberg@clientfirststrategy. If you have any questions, I'd love to hear from you. All right. Thanks so much. See you tomorrow.